We all get older, right? It's
Yeah.
like this universal human experience, aging. But what's fascinating is that globally, we're not just aging, we're living longer. And this isn't just something that affects us personally, it's reshaping economies all around the world.
Yeah, I think that the focus is shifting. It's not some far-off thing anymore. The paper we're looking at, Future-Proofing the Longevity Economy, it was done with Mercer. It really makes it clear this isn't the future. This is happening now.
Yeah.
And it's really impacting how our systems, like economic and social systems, actually work.
Exactly. And today, we really want to get into the meat of this white paper, pull out the important bits so you can really get a handle on what these longer lives mean for the economy. We're especially interested in what it means for financial resilience. Like, what does it mean for you and for the larger systems we depend on?
Right, and it's important to think about this in a broader context. The paper actually identifies 5 key trends that are really shaping this landscape. That are kind of the core areas we'll be discussing today.
So, what are these big things we should be paying attention to? Lay it out for us.
Okay, well, first off, there's the whole challenge of making sure our public retirement systems can actually handle these demographic shifts. Then there's the shift from just saving for retirement, like accumulating money, to figuring out how to spend those savings in retirement, which they call decumulation. The paper also looks at the increasingly important role employers play in our financial well-being. Then there's the often overlooked economics of caregiving and long-term care, which is huge. And finally, we'll look at different paths to economic growth in this new age where people are living longer.
Wow, that's a lot to cover. But that's why we're doing this deep dive. We're basically doing the heavy lifting for you so you don't have to wade through the whole report. We're here to pull out those nuggets of wisdom and the surprising stuff without making your head spin. So, let's start with that first big challenge. How do we keep our public retirement systems from going belly up as we all live longer?
Right, and it raises a really fundamental question. How do we ensure these safety nets are sustainable? The population is aging, life expectancies are shooting up, so it's a huge challenge. And the statistics are pretty mind-blowing. By 2050, the number of people aged 65 and over is expected to more than double globally. That's a massive demographic shift.
And of course, that leads to a kind of imbalance, doesn't it? Fewer people working, more people retired. It's like a seesaw that's getting heavier on one side.
Exactly, and the financial impact is huge. The paper projects that by 2060, if we don't make some serious changes, governments around the world could be looking at average deficits of about 9.1% of their GDP. And it's interesting, emerging markets might actually see even bigger deficits, something like 15.9% of GDP compared to more developed economies, which are around 5.6%. So it's definitely a pressing issue that needs attention.
Those are some scary numbers. Now, the paper also talks about how different countries have structured their retirement systems. Can you give us a quick rundown of these different approaches and how they relate to this sustainability problem?
Yeah, and what's interesting is how diverse the models are. Some countries, especially in Europe, rely heavily on what they call taxation-based state pension systems. Basically, what happens is the current workforce's contributions directly fund the pensions of retirees. It's all about sharing the risk across generations. On the other hand, you have places like the US and a lot of emerging economies where the focus is more on individuals building their own retirement savings through private accounts. Often there's some government support or regulation, but it's a very different approach. This difference really affects how responsible individuals feel for their retirement income, and consequently, how much the government needs to step in to ensure people are financially secure later in life.
So it's a spectrum, right? From more government-led systems to those that really put the responsibility on individual saving. And the paper doesn't just point out the problems, it also highlights some really creative solutions being tried around the world. Let's dive into those. First up, Canada's CPP, the Canada Pension Plan. What's so special about that system?
Canada's CPP is a great example of a system designed for the long haul. A few key things make it really stand out. First, it's run by an independent investment board, the CPPIB, so it's not influenced by political whims. This lets them take a more strategic, long-term approach to investments. Second, they cover a really wide range of people, not just regular employees, but also immigrants and people who are self-employed. They're really inclusive. They also spread their investments globally across all sorts of assets, which helps reduce risk. And importantly, they have regular independent reviews to make sure it's financially sound for the long term. Right now, their projections go all the way to 2090.
And I think the paper also mentions that the contribution rates for the CPP are pretty stable and predictable, which is a huge plus, right? Both for workers and businesses.
Absolutely. Both employees and employers pay a fixed percentage of their earnings, up to
Sure.
a certain limit. People with higher incomes contribute a bit more. This stability helps people trust the system because they know the rules won't change constantly.
Okay, next up is the pension system in the Netherlands. How are they tackling this challenge?
The Netherlands uses a multi-pillar system. So the first pillar is the AOW, which is like a universal state pension everyone gets. It's linked to how long you live and funded through taxes and Social Security contributions. Then there's the second pillar, which is occupational pensions. This is where they're making some big changes with the Future Pensions Act of 2023. They're moving towards something called collective defined contribution plans.
Collective defined contribution. That sounds like a hybrid of the defined benefit and defined contribution models we talked about earlier.
Yeah, you're right on the money there. These new plans, which they call solidary and flexible defined contribution schemes, still involve individual savings pots. But they do a better job of sharing risk, especially when it comes to investment returns and how long people live. This collective element helps them better handle economic and demographic shocks. And what's really impressive is that almost everyone in the Netherlands participates in these occupational pensions, about 90% of the workforce.
Wow, 90%. That's amazing. Okay, let's switch gears a bit and look at Rwanda's Ijoheza scheme. This one seems really interesting in terms of reaching more people, especially those who aren't traditionally covered by pension systems.
Definitely. Ijoheza means a bright tomorrow in Kinyarwanda, and it's a voluntary program specifically for informal workers and those with lower incomes. It's really accessible because you can use it on your mobile phone, which is really important in Rwanda, especially in rural areas. Another great feature is that the government matches contributions, sometimes up to 100% for the lowest earners. That's a huge incentive to save. It's also designed to be inclusive for all generations. Anyone in Rwanda can join, even children. They're trying to build a savings culture from a young age. The paper does say that savings levels are still pretty low, but it's a really innovative approach to getting more people financially included.
Mobile access and government matching those are two powerful tools. Finally, the paper looks at Malaysia's Employees Provident Fund, or EPF. What can we learn from them?
Malaysia's EPF is mandatory for everyone working in the formal sector. One cool thing is that it lets you withdraw some of your money for things like housing, education, or certain medical expenses. It gives you some financial flexibility alongside saving for retirement. Recently, in 2024, they introduced a new system with 3 accounts, one just for retirement, one for specific life events, and a more flexible one you can access for short-term needs. They've also launched programs like ISA-RANN, which gives you government matching for voluntary contributions. This is meant to encourage people in the informal sector to save, and it seems to be working. But the paper does point out that covering the huge informal workforce remains a big challenge for them.
So it's a constant juggling act, isn't it? Trying to make sure people have enough for retirement while also meeting their immediate needs. And then there's the whole issue of reaching people who aren't in traditional jobs. After looking at all these different examples, what are some of the key takeaways? What does the paper suggest we can do to strengthen public retirement systems overall?
Well, they really boil it down to a few key areas. First, you have to make sure the financing is sustainable, which might involve adjusting contribution rates and retirement ages. Second, any reforms you make should be gradual and clearly explained to the public so you don't cause chaos and everyone's on board. Third, you need to actively work on including people who are in the informal sector or the gig economy. Fourth, use behavioral economics to your advantage. Encourage or even mandate auto-enrollment in retirement plans. And finally, use technology to make these systems more efficient and user-friendly.
Those all make a lot of sense. Okay, let's move on to the second trend the paper highlights. Moving from accumulating retirement savings to the, well, maybe scarier part, managing and using those savings to actually generate income in retirement. They call this the decumulation phase.
This is where things get interesting. This is what stresses people out about retirement. We've seen this global shift away from defined benefit pension plans, where you get a guaranteed income for life, to defined contribution plans. And that means individuals now have to manage their own retirement income.
It's like going from having a pilot fly the plane for you to suddenly finding yourself in the cockpit. Not everyone's ready for that.
Exactly. This shift is what the paper calls the decumulation dilemma. A lot of people are understandably scared of running out of money, around 44% globally, according to the 2024 Global Retail Investor Survey. But here's the funny thing. Retirees who do have savings are often really cautious about spending them. The paper mentions that in the U.S., retirees often still have about 80% of their pre-retirement savings after nearly 20 years of retirement.
So they're worried about running out of money, but also afraid to spend it. Why do you think that is?
The paper suggests a few reasons. People aren't really sure how much they can safely spend each year in retirement, and there's this lack of longevity literacy. They don't know how long they're actually going to live in retirement. Plus, there are worries about the economy going haywire, which connects back to those concerns about the sustainability of public retirement systems.
And then there's the whole annuity puzzle, right? Annuities are designed to give you a guaranteed income for life, so you'd think more people would be jumping at the chance to buy them.
You would think. In theory, people should be clamoring for annuities because they help you avoid running out of money. But in reality, very few retirees actually buy them. In the U.S., it's only about 12% of people who could afford them. Even people who say they want the security of a guaranteed income often don't go through with it. They say they want to stay in control of their money, they're worried about leaving less for their heirs, or they're just uncomfortable turning a big chunk of their savings into a fixed income. The paper found that only about 17% of investors plan to buy an annuity. Most prefer more flexible options like investing in stocks that pay dividends or working with a financial advisor.
So control and flexibility seem to be more important to people than the safety net of an annuity, even if it means taking on more risk. So what about innovative solutions for decumulation? What does the paper highlight?
Well, there are a few interesting models out there. One is Singapore's CPF Life, that stands for Central Provident Fund Lifelong Income for the Elderly. It's a national annuity scheme that's part of Singapore's defined contribution system. A big reason for its success is that they automatically enroll people who have enough savings, which means lots of people participate and they share the longevity risk. Retirees also get to choose from different plans depending on how much income they want and what they want to leave behind for their heirs. Plus, there's a refund feature, so you're guaranteed to get back at least what you put in. The premiums and payouts are all based on actuarial calculations and adjusted regularly to make sure it stays financially sound. And because it's run by the government and so many people participate, the administrative costs are very low.
Automatic enrollment seems like a really effective way to get people involved. What's another example of innovation in this area?
The paper also mentions Brazil's Rende Plus bonds, which are offered by the government. These bonds are adjusted for inflation and pay you a monthly income for 20 years. They're linked to the IPCA, which is Brazil's main inflation index. It's a pretty simple way for people to turn some of their retirement savings into a guaranteed income that keeps up with inflation. To make things even easier, they have an online calculator so people can figure out how much they need to invest to get the income they want. The initial uptake was a little slow because some people were confused about the return rates, but it's a big step towards making sure people's retirement income isn't eaten away by inflation over time.
Yeah, protecting your money from inflation is crucial when you're thinking about a long retirement. And lastly, the paper talks about Australia's Home Equity Access Scheme, or HEAS. How does that fit in?
HEAS is a government-backed scheme that lets retirees tap into the equity they've built up in their homes without having to sell. They can get regular payments, a lump sum, or a combination of both to help with their living expenses in retirement. The interest rate is pretty low, and there's a safeguard that prevents people from owing more than their home is worth when they settle up. The paper points out that a lot more people are using HEAS now, suggesting that it's becoming a really attractive option for people who have a lot of their wealth tied up in their homes but maybe don't have a lot of liquid savings or just need some extra income. It's like unlocking an asset they already have to help fund their retirement.
It's a good way for people to make the most of their assets. Looking at all these solutions, what are the key steps the paper suggests for making sure people have a sustainable income throughout retirement?
It boils down to creating retirement income solutions that are structured, but also flexible enough to adapt to individual circumstances and changing needs. It also highlights the need for better financial literacy, especially when it comes to how long people are likely to live in retirement and making financial planning tools more accessible. Then there's the idea of using behavioral nudges to encourage people to make good decisions about their retirement income. It also suggests designing more financial products that balance flexibility with income security. And finally, it recommends thinking about ways to protect people from outliving their savings, perhaps by incorporating annuity-like features into broader retirement systems.
So it's really about making that transition from saving to spending as smooth as possible and making sure people feel secure and confident about their finances in retirement. Now, let's move on to the third trend the paper covers: the growing importance of employers in supporting the financial well-being of their employees.
This is an area that's really evolving. Employers are starting to realize that helping their employees with their finances isn't just a nice perk, it's actually crucial for their business. especially in today's crazy economy. It helps with productivity and makes the company more resilient in the long run.
It makes sense. If people are constantly stressed about money, they're not going to be very focused at work. It's bound to affect morale and performance.
Exactly. The paper actually mentioned some pretty compelling stats. The 2021 Global Findex survey found that a lot of adults around the world would have a hard time coming up with emergency funds within a month, and many are constantly worried about paying their bills. And studies have shown that people with high financial stress are way more likely, like 5 times more likely, to feel disengaged at work. But here's the thing. Another study found that most employers now feel responsible for their employees' financial well-being, at least to some extent. But the truth is, only a small percentage of companies actually offer decent programs to address this need.
So there's this awareness of the problem and a sense of responsibility, but it's not really translating into action. And the paper also mentions that a lot of benefits disappear when someone leaves a job, which is a real problem, especially when people are changing careers.
Absolutely. Things like health insurance, disability coverage, and even contributions to retirement savings plans are often tied to your job. So if you lose your job or switch careers, you might end up with gaps in your coverage, which adds even more financial stress.
But the paper does highlight some companies that are being proactive and offering innovative solutions to support their employees' financial well-being. What are some of the good examples they mention?
Oh, there are some great ones. Bank of America, for instance, has a really comprehensive program that covers financial education, budgeting tools, and personalized advice, and it's all linked to their existing benefits. CVS Health has an employee relief fund that helps people facing unexpected hardship. And over in the UK, Tesco, the supermarket chain, gives employees access to low-cost loans and early access to their wages to help them manage their cash flow and avoid getting into debt with high interest rates. Then you have companies like Adobe, who foster a culture of financial well-being with things like financial coaching and peer support groups. Siemens Healthineers in Germany actually redesigned their pension plan to increase contributions for part-time workers and apprentices. They're trying to close those gaps that can happen when people have non-traditional career paths. And there are a bunch of new companies like Northstar, Nudge, and Addition Wealth that work with employers to offer financial wellness services. They use things like behavioral science and personalized digital platforms to get employees engaged and help them achieve their financial goals.
So there's a real move towards going beyond the traditional salary and benefits package and providing more holistic support. The paper also talks about some interesting developments with employer matching contributions in the US. Can you explain that a bit more?
Yeah, so the IRS recently clarified some rules, giving employers more flexibility in how they contribute to their employees' benefit accounts. This means that employees might be able to direct those contributions not just to retirement plans like 401ks and HSAs, but also to things like retiree health arrangements or even to paying off student loans. This flexibility is a big deal because it lets people tailor their benefits to their specific needs and priorities at different points in their lives.
That's a big step towards recognizing that people have very different financial needs. And then there's the UK's experience with auto-enrollment in workplace pensions, along with the idea of sidecar savings. What can you tell us about those?
Well, in the UK, they automatically enroll eligible workers into workplace pensions. This has been incredibly successful in getting more people to save for retirement. Since they started doing this in 2012, participation in workplace pensions among private sector employees has more than doubled. Basically, by making saving the default option, although people can still opt out, they've overcome that inertia that keeps a lot of people from saving. And there's the idea of sidecar savings, which is gaining a lot of traction. It's basically a separate, easily accessible savings account that's linked to your retirement plan. You can set up automatic contributions to the sidecar for emergencies, and some employers even match those contributions. Early trials have shown that this is a really effective way to help people build up an emergency fund. This is particularly helpful for people in more precarious jobs like gig workers or people who might need to take time off work to care for family. It gives them a buffer to handle unexpected expenses without having to touch their retirement savings.
So it's all about making saving easier and addressing both short-term and long-term needs. What are the main things the paper suggests employers can do to improve their employees' financial well-being?
The key points are offering access to comprehensive financial wellness programs, including education, tools, and guidance. They also emphasize the importance of using behavioral nudges to encourage positive financial habits. Giving employees more flexibility in how employer contributions are used is another key recommendation. And then there's ensuring that people in non-traditional jobs, like gig workers, have access to adequate financial security and benefits. Ultimately, it's about making employee financial well-being a core part of the company's strategy and culture.
Great points. Okay, let's move on to the fourth trend highlighted in the paper, the economics of caregiving and long-term care. This is something that's often ignored, even though it's hugely important and has massive economic implications.
It's true. As populations age, the demand for caregivers, both paid and unpaid, and for long-term care services is skyrocketing. This puts a huge strain on families, communities, and the healthcare system. It's a fundamental part of this longevity economy that we need to pay a lot more attention to.
And one thing the taper points out is that unpaid care work is worth a fortune, but it's completely invisible in traditional economic measures.
Yeah, it's mind-boggling. The ILO estimates that unpaid care work is worth about 9% of global GDP. That's a massive amount of economic activity that we're just not accounting for. And the paper highlights the fact that this burden falls disproportionately on women. Globally, women do over 75% of unpaid care work. That often prevents them from fully participating in the paid workforce, which obviously hurts economic growth and gender equality. But it's not just about the economic value. Caregiving itself can be incredibly demanding, both physically and emotionally, and it can have a real impact on the health and well-being of caregivers, especially older spouses who are caring for their partners.
It's a huge burden on so many levels. And then you have the rising costs of professional care and the fact that a lot of countries, especially in the developing world, don't have enough long-term care infrastructure.
That's right. In a lot of developed countries, nursing homes, assisted living, and even home care services are so expensive that many people can't afford them. And the costs are only going up as demand increases. And in many developing countries, they just don't have the resources or systems in place to provide affordable and high-quality care. So families are often left to rely on informal care networks, which can be very challenging without proper support. The paper also emphasizes the lack of support for informal caregivers themselves. Things like respite care, training, and mental health services are often hard to come by. This can lead to burnout and negatively impact their own well-being. And on top of that, many countries don't even formally recognize the essential role these informal caregivers play.
It sounds like a system that's really struggling to keep up. Are there any solutions out there that are showing promise?
Well, there are some interesting developments. Japan, for instance, has this rapidly aging population, and they've been implementing something called a community-based integrated care system. The goal is to let older adults stay in their communities as they age, with all the care services they need within a 30-minute radius. They create personalized care plans, involve local resources, and use all sorts of technology like AI monitoring systems and companion robots to help people stay independent and avoid expensive institutions. It's a very holistic and person-centered approach.
That sounds like a great model. What about other innovations?
We're also seeing employers doing more to help employees manage their caregiving responsibilities. Companies like Salesforce and Microsoft are offering paid family leave and flexible work arrangements, while companies like Google and Dow are partnering with organizations like Bright Horizons, CareLoop, and CareHero to provide backup care and coordination services. And there are tons of startups using AI to improve home care and long-term care planning, like SiriCare, Honor Technology, and Waterlily. Finally, in the EU, they're starting to recognize the importance of giving people care credits in their pension systems. These credits mean that if you take time off work to care for children or elderly family members, you don't lose out on your pension benefits later on. France and Germany already have these systems in place.
So it's about providing support on multiple levels, community support, flexible work arrangements, technology, and policy changes. What does the paper say are the key priorities for creating a better care economy?
Well, they emphasize the need for better financial and workplace protections for caregivers. Investing in long-term care infrastructure is also crucial. And we need to address the gender imbalance when it comes to caregiving so that women aren't unfairly penalized financially. Technology can play a big role in improving the quality and efficiency of care. And we need to create more age-friendly policies and environments that allow people to maintain their independence and well-being as they age.
Okay, finally, let's talk about the fifth trend the paper discusses, finding ways to achieve sustainable economic growth in this age of longevity. The paper makes a really interesting argument about how we need to change our whole perspective on this demographic shift.
Absolutely.
Mm.
The paper argues that we need to stop thinking of this aging population as a burden and start seeing it as an opportunity for growth. We need to make sure people are financially secure and well off throughout their lives as they go from education to work, change careers, take on caregiving roles, and eventually retire. This is essential not just for individual well-being, but also for the overall health of the economy.
Because people aren't just living longer, they're also having more diverse and less predictable careers, right? The old model of going to school, having one job, and then retiring is becoming less common.
Exactly. People are more likely to change careers multiple times, start their own businesses, take breaks to care for family, and maybe retire gradually. Our financial and social systems need to be able to support these more complex lives. We need to make sure people have access to the skills they need, can get insurance, can save effectively, and have opportunities to keep learning and growing throughout their lives. The paper points out that by 2031, almost 25% of workers in developed economies will be over 55. So we need systems that support career changes, allow people to keep working if they want to, and make it easier for older workers to stay involved. And the paper highlights how taking breaks from work to care for family can really hurt people's retirement savings, especially women. And then there are all the people working in the gig economy as freelancers or in the informal sector. These workers often don't have stable incomes or access to traditional benefits, and they make up a huge portion of the global workforce, over 60%.
So, how can we create these more adaptable and resilient financial pathways that can support people throughout these longer and more complex lives?
The paper highlights some really interesting programs that are already doing this. One is Brazil's Bolsa Família program, which gives cash to low-income families. But it's not just a handout. Families have to make sure their kids go to school and get regular checkups. This has been shown to reduce poverty and also increase formal employment, and has been particularly beneficial for women. Then there's Denmark's flexicurity system, which is a really cool model. It gives employers a lot of flexibility, but also provides a strong safety net for workers. This includes generous unemployment benefits, lots of investment in adult education. Over 20% of adults were involved in some kind of education program in 2023, really good parental leave policies, up to 52 weeks, and help with finding jobs and training. This has helped Denmark keep unemployment low, even though their labor market is very flexible. And then finally, the paper discusses France's compte personnel de formation, which is like a personal training account. Workers earn credits throughout their careers that they can use for training, and their employers contribute to. This helps people learn new skills and transition between jobs more easily. They get a certain number of credits each year, so it gives them a lot of control over their own professional development.
Those are some really different approaches, but they all seem to be about providing a safety net and also giving people the tools and opportunities they need to adapt and thrive in a changing world. What does the paper say are the most important things we need to do to create these more resilient pathways?
They emphasize supporting lifelong learning and making it easier for people to develop new skills throughout their lives. They also recommend encouraging flexible work arrangements and making it easier for people to retire gradually. Making sure people who are working in the gig economy or as freelancers have access to benefits and financial security is another key point. And they stress the importance of strengthening public policies to help people navigate those big life transitions, like going back to school or taking time off to care for family.
So it's really a call for a fundamental shift in how we think about work, retirement, and social support. We can't just tweak the existing systems, we need to rethink them entirely.
Absolutely. The paper concludes by saying that we need to change our whole mindset and see this demographic shift as a positive force. They summarize the 5 key areas we talked about and stress that our old ways of thinking about work, retirement, and social support just don't cut it anymore. We need to work together to create policies, financial products, and employer strategies that give everyone more flexibility, resilience, and financial security throughout their lives.
And that means everyone needs to be involved, governments, businesses, and civil society organizations. We need to use technology and innovation to create solutions that work for everyone in this new longevity economy.
It's a call to action. The decisions we make today will determine whether these longer lives lead to more opportunity and well-being or more inequality and hardship.
This has been a really fascinating and thought-provoking deep dive into a topic that's affecting all of us. It's clear that we need to rethink our assumptions about work, retirement, and financial security in this age of longevity. And I think it raises a lot of questions for each of us. How might these global trends and the solutions we talked about affect your own finances, your career, and your vision for retirement? It's definitely something worth thinking about.